Welcome to my channel, Promotion for Sure. In this video, we are going to talk about Module B of Bank Financial Management, which is Risk Management. Now, this video will cover the entire module in a summary format. This video will make sure that you score enough marks to clear this module and this paper. So if you go through this video, it's a summary format. You will learn all the important aspect of this entire module. So if you like this video, you can press the like button. Please subscribe to our channel and share it on social media. Help us to spread education in this beautiful world. And if you have clicked to watch this video, be rest assured you have reached a channel that will give you a treasure of knowledge. That's a promise. So please subscribe and become a lifetime learner. Thanks for subscribing. Now, what is risk? Risk is the probability that the realized return would be different from the anticipated or expected return on investment. Risk is a measure of likelihood of bad financial outcome. All other things being equal, risk will be avoided. All other things are, however, not equal, and that a reduction in risk is accompanied by reduction in expected return. The uncertainties associated with risk element impact the net cash flow of any business or investment. Under the impact of uncertainties, variations in net cash flow take place. This could be favorable or unfavorable. The unfavorable impact is risk of the business. Now let us first understand the anatomy of bank risk. What exactly the banking risk look like? So if we divide it into two parts, it's non-financial risk and financial risk. And non-financial risk will have business risk, strategic risk, and financial risk will have delivery of financial services risk, balance sheet risk, and balance sheet risk will have operational risk, legal risk, and a reputational risk. So this is the basic framework of banking risk. Now, if we talk about credit risk, it can be divided into concentration risk and intrinsic risk. Concentration risk means once you are providing loans to a particular sector. Intrinsic risk means any loan which you give will have certain amount of risk associated with it, whether you want it or not. The second important risk is market risk, interest rate risk, liquidity risk, currency risk, commodity risk. Now, if we talk about interest rate risk, it is price risk, reinvestment risk, yield curve risk, basis risk, gap risk. Now, risk in traditional sense, if we talk about, involves two important aspects, which is systematic and unsystematic. So systematic risk will affect all industry, all securities, whether it is non-controllable, non-diversifiable. So if it happens, systemic risk is basically a system risk which will impact the entire economy, the entire banking industry, which is not actually in your control and things cannot be even diversified. Now, unsystematic risk affects specific industry, specific security, which is controllable and diversifiable. So when we say unsystematic risk, this means risk specific to a particular industry. For example, leather industry. So all the loans which you have given to the leather industry can be controlled. You can reschedule the loan. You can have conversations with the borrowers and plan out certain things. So this is something which you can do to avoid risk. Now, risk in banking business. Banking business is broadly grouped under following major heads from risk management point of view: the banking book, the trading book, and the off balance sheet exposures. Let's talk about the banking book. Now, all asset and liabilities in banking book have following characteristics. First, they are normally held until maturity. Second is accrual system of accounting is applied. Now, since assets and liabilities are held till maturity, their mismatch may land the bank in either excess cash inflow or shortage of cash on a particular time. Now, this is known as liquidity risk. Now, due to change in interest rates, assets and liabilities are subjected to interest rate risk on their maturities or repricing. Further, the asset sides of the banking book generates credit risk arising from defaults in payments of interest and or installment by the borrowers. In addition to all these risks, banking book also suffers from operational risk. Now, if we talk about the trading book includes all the assets that are held with intention of trading that are marketable. They are normally held for a short duration and positions are liquidated in the market. Trading book assets include investment held for trading category. They are subjected to market risk and are marked to market. Now, if we talk about off balance sheet exposure, it is contingent in nature, such as guarantees, letter of credit, committed or backup credit lines. So, contingent means it can happen or it may not happen. A contingent exposure may become a fund based exposure in banking book or trading book. It is known as call risk. Therefore, off balance sheet exposure may have liquidity risk, interest rate risk, market risk, credit or default risk, and operational risk as well. Now, if we talk about risk in banking, now risk is inherent in banking. You cannot avoid risk. So, if you give a loan to a particular person, even at the time of giving the loan, you may feel that everything is all right. But after a few months, things may not be well. So, risk is there in every banking operation. Now, banking is not avoiding risk but managing risk. So, risk management is all about managing those risks which can happen in the future. Now, risk in banking can be broadly classified into three risks. Credit risk is basically when the borrower does not pay the money due to any reason. Market risk is the interest rate risk. And operational risk is the risk which can happen because of internal fraud. Your entire system gets corrupt or hacked by some people. Now, asset liability management tries to address the market risk. Now, if we talk about the history of risk management in banks, let's go and talk about the first initiative taken by the industry to control risk, which was Basel Accord 1, 1988. In 1988, Basel Committee on Banking Supervision published a framework for a minimal capital requirement for credit exposure. The bank books were classified into five buckets, that is, grouped under five categories according to credit risk weights of 0, 10, 20, 50, and 100%. Assets required to be classified into one of these risk buckets based on the parameter of counterparty. Banks required to hold capital equal to 8% of risk weighted value of assets. In India, the minimum capital requirement is 9% as decided by RBI. So this is the Basel Accord 1. Now 1996 there was an amendment to include market risk. In 1996, Basel Committee on Bank Supervision published an amendment to provide an explicit capital cushion for market risk to which banks are exposed. Now market risk is the risk of adverse deviations of the market to market value of the assets due to market movements as a result of change in interest rate, market price or exchange rate. Now, then came Basel Accord. So, what was the need and goals of Basel Accord? Now, linking of risk with capital in terms of Basel Accord 1 needed a revision for the following reason. First, the credit assessment under Basel 1 is not risk sensitive enough. One suit fit all approach was applied to all types of entities with uniform 100% risk weightage. Risk arising out of operations were ignored, though it has potential of affecting the bank's survival. So if we talk about Basel Accord 2, it is based on three pillars. minimum capital requirement, supervisory review process, and market discipline. So these are the three basic pillars: minimum capital requirement, supervisory review process, and market discipline. Now, minimum capital requirement under pillar 1, which is credit risk, market risk, and other risk. Now, credit risk can be classified into standardized risk, internal ratings, credit risk models, and credit mitigation. Market risk in trading book and banking book, and other risk in operational and others. Now, minimum capital requirement, which is credit risk, the pillar 1, can be studied, can be analyzed through a standardized approach, through external rating, internal rating based approach, foundation approach, advanced approach, and credit risk modeling, sophisticated banks in the future. This is the minimum capital requirement. So this is the evolutionary structure of the accord. Standardized approach, then came foundation of IRB approach, advanced IRB approach, and credit risk modeling. So the new Basel Capital Accord, which is the standardized approach, it provides greater risk differentiation than 1988. Risk weight is based on external ratings. There are 5 categories: 0, 20%, 50%, 100%, and 150%. The loans considered past due be risk weighted at 150% unless the threshold amount of specific provision has already been set aside by the bank against the loan. Special treatment for retail and SME sector. So this is the standardized approach, new risk weighted as per January 2001. This is the risk category associated to various risk. So I'll explain you what exactly is risk in terms of banking loan. So if I give a loan to a government, the government will obviously make a payment to me. So there is no risk. That is 0% risk. But if I give the same amount of money to an industry, I may not be able to get back my loan because that's an industry that may work tomorrow or may not. So my risk is 100%. This is how, on the basis of the probability of losing the money, you assign a risk percentage to the risk. The new Basel Capital Accord, capital for credit risk, internal rating based approach. There are three elements: risk component, risk weight conversion function, minimum requirement for the management of policy and processes, emphasis on full compliance. Now, standardized approach versus IRB approach. This is the new standardized model. The new Basel Capital Accord, market risk as standardized method, maturity method, duration method, and internal models method. So, what is operational risk? It earlier stood for non-financial risk. Current Basel II definition is the risk of loss resulting from inadequate or failed internal processes, people, and system, or from external event. Internal process. So, any internal happening, maybe out of 100 employees of your organization, 50 are sacked due to some reason. So that is internal process. When a person makes a fraud, that is people. System, your entire CBS system is not working. That is an operational risk. External event. If there is a natural disaster, that is external. These are operational risks. If we talk about Basel II definition, it includes both internal and external event risk. Legal risk is also included, but reputational risk is not included. Direct loss are included, but indirect losses are not. So examples of loss events, you can go through it: internal fraud, external fraud, employment practices and workplace safety, damage to physical asset, business disruption and system failure, execution, delivery, and process management. Now, these are types of operational risks which can happen. I've already given you a basic idea. You can pause the video and you can go through it. The new Basel Capital Accord, capital charge for operational risk. As in credit, three alternate approaches are prescribed: basic indicator approach, standardized approach, and advanced measurement approach. Basic indicator approach is the capital charge for operational risk. To begin with, RBI has advised banks to follow basic indicator approach in India, which is 15% of the average gross income over 3 years. Now, the capital charge under the basic indicator approach, this is the formula which you can go through. Standardized approach, alternate standardized bank activities divided into 8 business lines. Capital charge is sum of specified percentage of each business line. This is the basic formula which you can certainly get into. This is the level of the beta factors. Now, what are the advantages of this? Simplicity, limitations, it's blunt chart, not risk sensitive. It fails to capture effect of banks management and operational risk. Advanced management approach, capital charge for operational risk. Capital is firm specific calculation, statistical based methodology. It is intended to overcome the lack of risk sensitivity in simpler approaches by setting regulatory. These models use the bank own metrics to uh, measure internal loss, external loss experience, scenario analysis, and risk mitigation techniques to set capital commensurate with the operational risks posed by the bank activities. This is the advantage of the advanced measurement from basic indicator to standardized. Comparing operational risk with market risk and credit risk. This is a very important chart which you can go through, pause the video, and you can see the basic difference between market risk, credit risk, and operational risk. So new Basel Accord 2 supervisory review process, it defines the role of supervisors with regard to capital adequacy, market discipline, disclosures requirement that allow market participants to assess key information about a bank's risk profile and level of capitalization. Value at risk is defined as the predicted worst case loss at specific confidence level over a certain period of time, assuming normal trading conditions. So, value at risk, there are three main approaches to calculating value at risk: the correlation method, which is also known as variance and covariance matrix, historical simulation methods, and Monte Carlo simulation. So, comparison of various modules, you can go through it, you can pause the video and you can just read it. What is the advantages of this? It captures an important aspect of risk in single number. It is easy to understand. It asks a simple question: how bad things can get. Now, what is back testing? It is a process where model based value added response is compared with the actual performance of the portfolio. This is carried out for evaluating a new model or to assess the accuracy of the existing model. What is stress testing? Stress testing essentially seeks to determine possible changes in the market value of portfolio that could arise due to non-normal movement in one or more market parameters. Now, stress testing covers many different techniques. Some of important ones are simple sensitivity test, scenario analysis, maximum loss, extreme value theory. Now, risk monitoring and control. Risk monitoring and control calls for implementation of risk and business policy simultaneously. This is achieved through the following: policy guidelines limiting roles and authority, limit structure and approval process, system and procedures to unbundle products and transactions to capture all risk, guidelines on portfolio size and mix, define policy of market to market, limit monitoring and reporting, performance measurement and resource allocation. So let's see some of the important MCQs which may come in the exam. A bank reports a 1 week VAR for 1 million at 95% confidence level. Which of the following statement is true? You can answer in the description box below. However, you can also get the answer from this slide. And the answer is D. With probability of 5%, the company will lose 1 million or more in 1 week. Okay. Netting is a method of aggregating two or more obligations to achieve a reduced net obligation. The benefit accrues from netting is, so what is the benefit? All of the above. It reduces the credit risk, liquidity risk, and systemic risk. Third, how is the risk of so-called catastrophic losses dealt with? Okay, the answer is C, by proper disaster recovery plan and business continuity plan in place. Money market funds are generally considered to have dash interest rate risk and dash default risk. So the answer is A, which is low interest rate risk and low default risk. The June 1999 Basel Committee on Banking Supervision issued proposal for reforms of its 1988 Capital Accord, which is the Basel II proposals. These proposals contain mainly uh, answer D, which is 1, 3, and 4. One is settlement risk management. I'm sorry, 2, capital requirements, supervisory review, and market discipline. Question: if the default probability of A rated company over a 3-year period is 0.3%, then the most likely probability of default of the same company over 6-year period is? The answer is D. Which of the following procedure is essential in validating the VR estimates? Answer is A, back testing. Loans are securitized to. Why are loans securitized? To reduce credit concentration, reduce regulatory capital, provide access to loan products for investors. If the volatility per annum is 25% and the number of trading days per annum is 252, define the volatility per day. Okay. When the cost yield of liabilities assets are linked to floating rate and there is no simultaneous movement in the interest rate, it leads to. Quite a few models were developed in the last few years to measure credit risk exposure. Which of the model below is based on the actuarial concept? It is credit risk plus. What is internal models approach? Answer is A, the method of calculating regulatory capital using a firm's own internal market risk model and data. So I hope this video would have given you a lot of valuable insight and a very good resource for summarizing the entire module of risk management. So if you click to watch this video, be rest assured you have reached a channel that will give you a treasure of knowledge. That's a promise. So please subscribe and become a lifetime learner. Thanks for subscribing our channel. Have a great day. Bye bye.